Hey guys, it's Nick. As you probably all know, the Dow crashed almost 900 points on Friday, and I'm sure many people are wondering if the stock market will continue to drop more or bounce from here. I'm not going to pretend to know, but looking at some of the data and how it compares to the past can give you an indication. Now, the past is not an exact replication of the situation we are in today with rising energy and food costs, rising inflation and interest rate expectations, and the hangover of trillions of dollars in pandemic spending paying people to stay home. However, human nature doesn't change much. So let's see where we are now and see what was going on during past market crashes. So the catalyst for Friday's sell-off was the CPI that surged by 1%. And so that is a new 40-year high of a annualized 8.6% year over year inflation. And so you see where we are compared to the last 40 years. We haven't even approached that kind of level until 1980 or so, 1981. So the higher prices for everything has crashed consumer sentiment, and the University of Michigan Consumer Sentiment Index crashed from 58 to 50, which they were expecting 58.1. And this thing is a record low. That is the blue line here. It is even lower than it was back around 1980. So we are in uncharted waters here with inflation, consumer sentiment, all that kind of thing. And yet the Fed rate hike expectations are just increasing, which is strange because while they're increasing, this is the rate cut expectations flipped around. And so they expect that the Fed is going to raise rates, but we are going to hit a really bad recession where they will have to cut rates after that. So Bloomberg is saying the market is now pricing in 10 more rate hikes by the end of 2022 and then 3 rate cuts following it when everybody is out of work, I guess. So with economic conditions we haven't seen in a really long time, the S&P is acting in ways we haven't seen in a really long time. And it is down 10 of the last 11 weeks, which is the worst stretch since the Great Depression. So maybe you're thinking, well, if it's down so much, maybe it's time to buy the dip already, right? So here's the historical PE ratio of the S&P 500. So let's see how cheap it really is. So recently we were as high as it was during the internet bubble, but we have come down a lot and now it's sitting at around 17. And that is actually around the long-term average forward PE for the S&P 500. However, you see in big downturns, it doesn't just stop at the average, it overshoots way lower. And so here in 2009 and 2011, around there, it overshot to about, what is that, about 12, 11, something like that. So usually a bear market ends when everybody is bearish and don't want to talk about stocks, let alone buy any. Well, let's see what Fidelity customers did on Friday with this 900-point down day. Were they selling stocks or were they buying the usual suspects? The buy to sell ratio on Tesla was 68%. The buy to sell ratio on the triple Q ETF, which is the 3 times leveraged QQQ, is still 63%. Apple, 74% were buyers. And the short QQQ were better sellers than they were buyers. And of course, Amazon, almost 76% buyers, and SPY, 67% buyers. So people are still trying to buy the dips here. I would be a lot optimistic if these percentages were reversed on a big down day and you see everybody selling and the percentages are like Tesla selling 70% and buying 30% or something along those lines. And another way to tell if we are at maximum pessimism in the market is to look at the VIX, which is the volatility index, or people call the fear gauge of the market. So during the internet bubble, it rose as high as 40 or so. And at the peak of the downturn during the 2009 financial crisis, it went as high as like 70. And during the pandemic shutdown, it also went as high as about 66 or so. So recently it got as high as 38, but now we're back around in the 20s. So I wouldn't think that we are at capitulation until we see some kind of spike like this or this. So let's see how some stocks act during market crashes. This is Amazon. This is a monthly chart. Every bar is 1 month, and this purple line is the 50-month exponential moving average. Now, these are split adjusted prices, but at the high during the internet bubble, Amazon was 565, while the EMA was like 160. So it was 3.5 times higher than this line. When the bubble burst, it fell as low as 28 cents, while the EMA was still like $1.40. So it was 4 times higher than Amazon stock. I don't know about you, but I'd rather be buying it way under the exponential moving average than when it is way above. And the stochastic and the MACD bottoming out and crossing over way down here is an indication that the trend is bottoming out and now it's starting to go up again. And during the financial crisis, same kind of thing. Amazon is way above the EMA and drops below it before it turns around. And where are we now? Well, here we are. Amazon has now dropped below the EMA. How much further will it go down before it starts turning around? Well, who knows, but the MACD is getting to that level. So maybe around 80, 70, something like that. Who knows? Same goes for the S&P 500. This is the SPY ETF during the internet bubble, way above the EMA and bottomed out way below the EMA. Same with the MACD bottoming out here. And the financial crisis, again, rather be buying down here than up here when everybody loves it. And so here we are again, highly extended above, and we are not even at that level yet of breaking through there. MACD is just turning from a top heading down. So how much more do we have to go? I don't know. And here is the QQQ ETF, the NASDAQ 100, and it looks a lot like the Amazon chart during the internet bubble. And here it is during the financial crisis. And here we are now, and it was way extended over the 50-month EMA, and it looks like it's about to touch it soon. But MACD is still just turning down now. So how much longer does this have to go down? Who knows? So here we are now. The QQQ was extended way above the 50-month EMA, and it's just now about to touch it, probably pretty soon, around 270 or so. But the MACD is at a peak, and it looks like it crossed and is just now heading down. So it looks like there could be a lot more to go down before this thing bottoms. So when you see where we are now compared to past downturns, to me, it doesn't look like we're at the bottom yet, especially since we didn't see a huge VIX spike and a capitulation type market where it just falls every day like it seemed to in 2009. The problem is that you have to have cash to buy it when it is close to the bottom. Since most brokerages and analysts always say to be fully invested, most people stay invested all the way down and are more likely to sell close to the bottom to end the continuous losses. Now, this is just human nature and why when you do the easy thing of following the crowd, you end up buying when everybody loves something and selling when everybody hates it. Of course, it's easy to say what should be done, but hard to do it in practice when the market seems like it is going straight down for weeks. If it was easy to do, everybody would be rich, right? Hope you like this video, and I'll see you in the next one. Thanks for watching, guys.